Well, thank you, everybody, for coming today. During this session, we're going to talk a little bit about LP trends and fund formation. We're going to talk about a little bit about different examples that we've seen and that is publicly available information, so as not to relate any client confidential information. Any questions you have, we can discuss at the end, or you can see us at milling around afterwards. My name is Steve Tirrell. I'm a partner in the Boston office of Morgan Lewis in the Investment Management Practice Group. I'm also the co-leader of Morgan Lewis's global private investment funds practice. And to my left here is my partner, Leonora Shalet, who is a partner here in our New York office.
Lovely to meet you. As many of you already know, our group is split between LP side and sponsor side representation, which gives us a unique perspective when advising limited partners and in particular family offices. And we have, over the years, tried to create a little bit more structure around our family office representation. And today, as you may already have heard, we have a family office initiative which groups together the various attorneys at Morgan Lewis across the globe who service our family office clients. Just a little bit of background on that. But I think let's start to talk maybe about some of the strategies that are really hot.
Yeah, I mean, that's a great segue into some of the things that we're seeing in the family office side, and particularly even in the just a LP institutional investor side as well. The secondaries market continues to thrive and expand, both on the GP-led side and the LP-led side. Now, interestingly enough, the secondaries market has evolved over time from being, sort of a sign of weakness or either the manager or the investor being in distress. But now it's being used as a tool, particularly on the investor side. Right? And some of the reasons that you see LPs take advantage of the secondaries market is one, obviously, to get a discount to the fund interest that's being sold.
Oh, sorry, I'm just going to jump in here. I did get a question yesterday on discounts for secondaries interest. And it is an interesting question. What I will say is it's a very difficult question to answer because it depends on so many permutations, including the strategy, the manager, whether it's a GP-led secondary or an LP-led secondary. But what I can tell you is that the discount is dropping now. It's not dropping to the levels that we saw in 2020, 2021, but it is dropping and it is expected to drop further. But sorry for interrupting you.
No. I mean, it certainly seems cyclical, right? I mean, I think in 20 and 21, we saw less certain valuations. And so the market sort of kind of dried up for a bit. And we saw broader and steeper discounts than we're probably seeing now.
Right.
The second reason is to gain access to an otherwise closed fund or even a direct investment in a portfolio company where the board of directors or management of the portfolio company has decided they're not going to allow certain transfers, right? And we're seeing creative mechanisms to gain access to these secondary interests, whether it be participation or derivatives. Sometimes it's just to gain access to the economics of the underlying security, or and other times it's to ultimately gain beneficial ownership at the end of whatever the term of the participation or derivative is. Now, the third place that we're seeing secondaries, LPs take advantage of secondaries is to rebalance their portfolios, right? And on this note, by the end of the second half of 2024, I think about half of institutional investors were over-allocated to the private equity side, even though they're still continuing to participate into the secondary markets.
Yeah, it's interesting because of this over-allocation or imbalance, what we're seeing is that when, for example, a manager is running a continuation fund process and giving its investors the option to either roll into the continuation fund or sell, approximately 90% of LPs, again, because of the over-allocation, want to sell. And luckily for them, whilst the overexposed LPs are trying to get out of these funds that they've been in, on the other hand, you have many investors trying to take up the opportunity. And in fact, Mass Prim is one of them. And what you're seeing is adjustments in policies and procedures in order to be able to effectively participate in continuation funds. ordinarily you'll have 20 business days to make the decision. So it's a fast turnaround. And large investors like MassPrim are changing their policies, procedures in order, for example, to not have to go to investment committee to get approval for a continuation fund.
Well, and certainly we heard earlier about the creativity and speed in which family offices can make investment decisions. So you're seeing more family offices participate in these GP-led secondaries and continuation funds. So we're also seeing continued interest in co-investments, right? For the associated returns, and two, for cost savings. Generally lower management fees or no management fees and lower carried interest. Talking about MassPrim, their current co-investment program has not only been accretive, as they've said publicly, to their overall PE returns, but has also saved them meaningful fees and carried interest over time. Broader data supports this point, showing that just over 2/3 of investors plan to participate in private equity co-investment opportunities over the next 12 months. That's up 64% from the prior year. And in my experience, investors tend to access or participate in co-investments a couple of different ways. One is through investments in main funds. They have the ability then to negotiate side letter terms where they can access to co-investment opportunities. The other is to facilitate direct relationships with individual managers that might not be invested in their main fund, but they can see deals on an ad hoc basis. So we're seeing trends of LPs scaling up their capabilities in order to evaluate these types of opportunities, right? Because it takes experienced personnel in order to look at these deals, right? And in the case of Texas Municipal Retirement System, we just saw them hire three new personnel in this space in order to start taking advantage more of these opportunities.
Let's talk for a minute about managers' strategies of interest. A lot of investors are looking at specialized managers. So as you may have seen, Wes Bradel, the head of investors for Florida SBA, said this week on Tuesday at the IPEM Paris conference that not only do investors want the top quartile returns, but they also want repeatability, and they believe that you can achieve repeatability through specialization. And so at this point, if you look at the Florida SBA's private equity portfolio, about 80% of it is with specialized managers, with the balance, the 20% balance being exposed to generalists. And this is not an uncommon trend, because if you look at the data and specifically specialized private equity funds in niche strategies, and we can talk about those a little bit more later, but they've all outperformed the generalist managers over the past 10 years, delivering multiples on invested capital of 2.1 as opposed to the average of 1.8 in private equity generally. But again, we've talked a lot about adjustments being made, right? The Texas retirement system hiring more personnel, MassPrim changing its policies and procedures. To the extent you want to look at these managers, again, you're going to need the resources, the manpower, because you're typically offering a smaller check size at this point.
Well, and as a side note, we're seeing just generally the investment management industry getting more involved in artificial intelligence, incorporating the artificial intelligence, the AI software that is coming out into their workflow process, right? And we're also seeing that with our family office clients for the exact reason that you talked about, right? When you're seeing more opportunities, you have more personnel costs, more manual labor in order to evaluate these opportunities. So being able to hopefully reduce the amount of manpower and the time, because again, we talked about earlier how quickly these opportunities come about and how you have to make decisions very quickly, right? And if you're looking at a lot of them on a lot of opportunities on an ad hoc basis, you've got to find a way to find these efficiencies as you come about, right? And so, I mean, but with AI, there's a lot of issues there, right? And people have talked about it. The SEC has been involved, the DOJ has been involved in certain things. You've got to understand what the limitations, I think, are. In our business, we're seeing it, right? The limitations of artificial intelligence are where the pros and cons are and where the pitfalls are. And also, you got to worry about data integrity, right? Where is the AI pulling the information from? So but I did read just today, NVIDIA's AI and financial services report, its most recent one is 91% of financial services firms are already using AI, or they plan on using AI this year into the next year. Right, so it's not going away, and it's going to change all of our businesses. So figuring out a way to incorporate it into our workflow, and whatever that workflow is probably the best way to figure out how to take advantage of it in the short term and the long and in the medium term as the software gets better as it goes along. Yes.
We'll give you a pass, even though questions are at the end.
Hi, John. Great.
How exactly, give me prompt engineer, how are you using ChatGPT or
I'm gonna request that we hold all questions until the end, because that was actually a special request that was made earlier this morning. If that's okay with you?
Well, we can answer this, but just from a timing perspective, I think we ran a little long. But how are we using it? I think you'll find generally most firms like ourselves or international firms beyond law firms are using it with a lot of caution, because we can't input confidential data into ChatGPT unless we fully control it. And then
I think most law firms have a policy not to use it. Can we just continue?
ChatGPT, no, but something within a sandbox, yes.
Yes, I agree with that. Formally, we're not. Also, turning to, I'm sorry, my phone is
Probably a question from the audience.
exactly.
Just kidding.
All right. So turning now to the terms that the LPs are focused on, particularly in the closed end space, they continue to focus on the key person terms, right? More in the way that the key person events are structured, and to make sure that the actual persons that are making the decisions are being the ones that are included in the key person events. And we see that more on the smaller managers than we do in the larger managers, right? Because the larger institutional managers usually have a broader team. They have a process whereby they have a team that is making a decision. If there are people that are coming in and out, they have a process whereby they can replace them, right? Not that we don't have key person events in larger fund and institutional managers as well, but we tend to see the negotiation more around the smaller managers. And what we're also seeing is when we have a key person event, what is the consequence of that? LPs tend to continue to focus on not just that the investment period suspends, but that it automatically suspends, right? A lot of times managers want to draft their fund documents such that if there's a key person event, you go to the LPs vote, and then they suspend it until there's a key person, a replacement key person. What the LPs are pushing back on lately is an automatic suspension, almost flip it, and then go to the LPs when you get a key person to turn it back on. We're also seeing a little bit of a trend, and I think you and I were talking about this earlier, a little bit of a trend to extend that not only from the investment period, but also into the harvest period, right? So if there's a key person event that happens during a harvest period, what are the consequences to that individual fund during that period? Do they suspend all operations until they get new key persons? Do they start, does it flow into a GPU removal event? Those types of things. And there's a little push and pull between your managers and your LPs that are investing in these closed-end funds.
And just by way of context, what I would say is investors, LPs are always pushing for a lot of terms, and the balance of power shifts, and at the moment it is such that it is in the hands of the LPs. But managers are still being very careful to ensure fairness among investors. They're still involving their COOs, their CFOs in the conversations with investors in order to ensure that the requirements can, as a practical matter, be met, but also that the burden from an operational and cost perspective is not excessive. And so to the extent you're an investor in a fund, you'll have experienced pushback for reporting or bespoke notice requirements. They try and keep consistency. But again, currently and generally speaking, the balance of powers is with the LPs. So GPs will try and be accommodating. They'll also resist making changes to fund documents for existing strategies that they're going to roll out again, because they know that they'll scare away existing investors with excessive redlining. And as I said, these are general remarks, right? If you look at fundraising, The secondaries funds have been doing super well. The real asset funds have been doing very well. Fundraising for VCs, real estate, and fund of funds has been a little slower. So again, when we talk about a balance and who's going to be giving you the terms that you want, or who's going to be a little bit more challenging in negotiations, it really depends who you're dealing with. But perhaps we can come back to the key terms that they're looking at after that context.
No, yeah, I totally understand that. One area of focus that we're also seeing the LPs is the evolution of transparency, particularly in fees and expenses. Now, we saw that with the private fund advisor rules, right? Where the SEC tried to impose a certain way of reporting for these fees and expenses, right? And some of these private equity funds and these other venture funds can be very complicated and complex, and there's can be a lot of leakage in the fees and expenses depending upon, whether it's taken at the fund level, portfolio company level, or some affiliate that may be providing services, right? And so just last month, ILPA proposed a revised version of its template for quarterly fees and expenses reporting. They had one for PFAR when it was, before it was struck down by the Fifth Circuit, but they've revised it now. And it looks like they're going to continue to push for that type of reporting. They're looking for comments by the end of October. They're hoping for the voluntary acceptance of that type of reporting, and that the market takes it on as a standard. We'll continue to see if that happens and whether or not managers will continue to push back for flexibility and other reasons that they're for their own business and commercial reasons in their structure to push back on that. But it'll be interesting to see what happens there in that regard.
Yeah, or investors, right? Because the problem isn't just, the problem with the form isn't just the manager saying, I can't make this work. Frankly, for the most part, it's the investors saying, no, we want to be able to compare like for like. And so we want you to use this forum for us. And this desire for customization, for bespoke products, means that we still see a lot of separately managed accounts, SMAs, or funds of one. And these are great because it enables you to have an individually curated mix of strategies, specific economics that you want and that work for you, to accommodate your legal, your tax, your regulatory, your internal requirements. Now, there's a little bit of a challenge here. The investors want these. They're a little bit expensive to set up. They're a challenge to set up. So in that respect, they're not a manager's favorite. However, on the plus side, and the economics tend to not be as good as the pooled funds for managers. But on the plus side, it does represent evergreen capital for a manager. And also where a manager, like if you're looking at a Bain, at a Carlyle, where they have an overflow of investment opportunities, they can satisfy the requirements of their funds, then of these SMAs, funds of one, which will still pay better fees than co-invest, and then trickle down to co-invest. So they are still an interesting option for managers who are obviously in the AUM race and wanting to grow.
And in the family office space, we're also, obviously one size doesn't fit all, right? So you have newly acquired wealth, you have generational wealth, and we talked about earlier that they're involved in, it can be very speedy in terms of the way they deploy capital. They're also starting to move into third-party capital raises, which brings up registered investment advisor issues. How do you separate from the family office? As they bring more talent in-house, they're thinking to themselves, well, hold on a second, we can do this on our own, and we can actually do this for third-party capital, not just for family office and obviously for the family office. And obviously that brings up the registered investment advisor aspect and whether or not, and how to keep your ethical walls in place in order to continue to rely on that exception. We're also seeing family offices getting less involved in less conventional strategies and objectives. ESG and impact strategies is a big one. And Morgan Lewis has devoted a lot of resources to the ESG and impact strategy funds as of late. And we're seeing an increased, not reluctance, the opposite of reluctance, desire for family offices to do something with their capital that makes a difference, right? And so, so for example, we're Blue Haven Initiative, which is one of the first family offices created with impact investment as its primary mission and focus. And a lot of our family office clients want to do something good with their money, and we see a move towards those types of strategies as well.
And obviously the hope there is that there'll be a return. That is part of Blue Haven Initiative's mission. But unlike, other LPs like a pension fund, they're not constrained by the requirement to generate periodic returns. So they can wait for this impact or ESG investment to produce a return. But obviously, that tends to be, as Steve was saying, a less conventional approach, which we do see a lot with family offices. But of course, we see a lot of family offices flocking towards the very popular strategies, and we touched upon them earlier. Obviously, real assets is a big one. The secondary space is a big one. And what I mean by that is not just participating in a secondary transaction, either as the seller or the buyer. It really is buying into a secondaries funds, and there are a number of them. Other very popular strategies include the entire credit spectrum, be it public credit, private credit, and again within that you see a spectrum. You see, the specialized managers, and we talked about those, and they're a real area of attention and focus for LPs. And an example might be, Marty, you were asking, so I really hope you're interested. For example, where the underlying asset is something that's harder for your typical lender to underwrite. So they're looking at, royalties or IP. And that's something that we're seeing our family offices and LPs generally really interested in. And it's a differentiator in terms of the returns.
Well, that wraps up our panel today. Marty, I don't know, I haven't been paying attention to the timing here. 5 minutes? Okay, so.
I was going to add one last thing, actually. Just one thing that's come up recently from family offices relates to the latest FinCEN AML rules. And I don't know if this is a concern for your family offices, but some of the family offices are saying, well, how is this going to impact me? What sort of information is the manager going to be asking me for? And how are they keeping this information safe? And at the moment, because these rules have just become effective, it's difficult to say, looking again, and this is where having a practice that covers both the LP side and the sponsor side is helpful. Looking at what our managers are doing, they are trying to stay within the parameters of what they have done historically, if that can give you any crumb of comfort. But that is something that we've been asked about quite a lot recently. But again, if anyone did have any questions. So the secondary funds, and by the way, there is a secondary panel this afternoon. So to the extent of your interest, I encourage you to go. But no, secondaries funds aren't necessarily trying to buy and then resell it. They're buying to hold. Oh, I see what you mean. Right. That's a great question. I don't know the answer. Yeah, so we're on the fund formation side. So we're the humble people that coordinate the raising of the capital to make that investment.
Quick question on formation SPVs.
Yeah.
But of size. So I do.
You're talking there.
Pardon?
You're talking there.
Yeah, exactly. So quick question, SPVs, let's just say I'm doing real estate deals, recaps, specific, restructures are going on right now, very attractive, but it's $10-15 million SPVs, and maybe me and one other or two other families that do it. One, what are the new rules that are going in? Is even worth it? And now the SEC, and I'm happy to talk about AML, FinCEN. I office investing, is it economical to do a 10 or $15 million SPV? I know I can't afford more, it was not worth your time to form or structure that. What are your suggestions for that? How do you do a small SPV, especially with the new regulatory changes that you were just discussing?
You know, I don't know what Steve thinks about this, but I would tell you, unfortunately, you're right that there are really no economies of scale. However, you know, what we have seen many family offices do in co-investment situations is create a co-investment platform where you're trying to use the same template with permutations. And of course, your co-investors coming in will say, well, this term doesn't work for me, but they try and create a co-investment platform so that there's an upfront cost, yes, but then, you know, over the course of time, the expense is lesser. The other thing you see people do, and you know, it doesn't necessarily work as well, is instead of offering legal ownership, they'll do participations or derivatives. I think that's perhaps a bit more complicated than it needs to be. And on your cost point, I don't think it saves anything. But
The need for an audit now, I know that's new this year. So I have one other partner, another family that I know in Dallas, and we're doing something together, I have to provide an audit now.
so the audit requirement, it sort of depends. I mean, registered investment advisors are obligated to do an annual audit in order to comply with the custody rule under the Advisors Act. Your alternative is a surprise examination by a PCAOB approved accountant. So that's one thing. And obviously the easier route is always doing an audit. So you mentioned obviously being obligated to comply with SEC and FINRA related requirements. To the extent you are an RIA, you already had that.
That I get, but I don't.
I love this topic. I want one, we're short time, but any more questions? If you don't have a question, I have a question. If you talk about, you know, so one of the big issues that's happened from all this capital reform in the last 20 years, and more recently, there was a lot of momentum into real estate syndicates. Can you talk about where capital stack falls into play, you know, in terms of how many investors in a fund, et cetera, especially in a private fund, you know, which isn't necessarily a hedge fund, right? Like private equity or venture capital.
Closed-end style, yeah.
Because one of the big issues that happened with these syndicates that were organized in real estate was that there's just too many investors and none of them were scale. They had scale. So when things went south, nobody could step forward and make things, you know, save the deal, let's say. Are you seeing any repercussions as a result of that in terms of people like LP saying, we only want to get involved in deals or funds where, you know, it's restricted in terms of numbers of people or the minimum? Are you seeing people respond to that, or what are you seeing?
I don't know what you think. I'll do on this. I think syndicated deals only work to the extent everyone's willing to step up.
Yeah.
And so what you'll often see actually is the use of a commingled fund where the investors will come in and are led by a general partner that makes decisions for them. Because as a limited partner in a fund, you're a passive investor. You don't get visibility into the information. You don't make the decisions necessarily. Now, it's a decision you're making. To the extent you want and expect active participation with respect to any underlying investment, then that's not the route you're going to go. But in the scenario you're describing, and to fix the issue that you're raising, which is no one stepping up to the plate.
Exactly right.
You know, you're better off in a sort of passive investment model through a fund. And the problem with that though, is you're paying for it.
Right, you're right. I mean, so a lot of these syndicates, because we were, I guess, in a FOMO period, is that the correct phrase?
Right.
And a lot of people just say, hey, I got to get, you know, they're like in Texas and Florida, I got to get into this deal. Or I'm not getting any returns from this type of investing. So I'm going to throw it all into this real estate deal. Real estate never loses value, et cetera. And then all these deals fell apart, right? Because interest rates went up rapidly.
Marty's an excellent point. I'm seeing the other side of that. They're coming to me because LPs won't step up for certain. Some will, some won't. So you're exactly right. That the syndicators are like, well, what do I do? And then.
I'm just saying, where does the knowledge loop back into the family office circle that say, don't do that anymore? Or watch out for these sorts of syndicates where you don't have people with any kind of, capital availability to make things right. That's a big issue.
Yeah, you want to know who your other partners in those syndicate deals, they didn't know, right? So they're just like, at the country club, oh, we'll put in 2 million into some multifamily thing in Austin, which is blowing up right now, and I see the deal.
Yes, right. So, right. And we actually talk a lot, and you talk about transparency. And what about the transparency to the limited partners in these funds? I mean, that's pretty.
In terms of.
Being able to say who they are and what they're, and being able to investigate who they are and their scale.
But there's less of a need. You could theoretically, but there's less of a need because those are the passive LPs. You don't need to care about them. What you need to know is who your co-investor in the syndicate is, and that's the fund. And effectively, that is the manager. And you will often have that transparency in these types of deals.
2 more questions.
I hope it's not a business question. Refer that to the M&A.
Well, that was my second question was, asked another follow-up question, which is, how many of these LPs have capital on call rather than capital in the fund? Because in 2008, what we saw was a lot of LPs sued not to pay their capital on call because it was cheaper, right? They put their money into the VC fund or the private equity fund. They had fear of losing everything, but they just litigated it.
Well,
It was just
right.
from the LP point of view, what's
Right, so it's actually the other way around. So what was happening in 2008, et cetera, is the LPs were being sued. They weren't suing. They were just saying, well, we're not paying. And then the managers, of course. And but what you'll have seen over the course of the last few years, 10 plus years, is an evolution in default remedies. And right now they're very aggressive. So it's not just a case of we can commence an action against you. That's always available to you, but they have more automatic remedies. So, and it's not just you'll pay interest on what's due, because if you're not paying now, you're probably not going to pay me later with interest. So it's things like, you have to forfeit any interest you currently have. So if you've put in 1/3 of your capital, you've lost it, and it's transferred automatically to other people. It can be sold to other people, including affiliates of the fund. So you see a much longer list of default remedies now. And they apply automatically without the need to go
from
to
an
court.
LP point of view, should you be wary of those default remedies?
It's funny, whenever I look at default remedies from an LP's perspective, my advice to the client is, look, it's going to be really hard to push back on this. You are committing to make an investment in the fund. I can sit there and debate the fairness of this and that remedy, but the truth is you just need to do what you said you were going to do, which is fund your commitment obligation.
And we've always had default remedies, right? So to me, and with my clients, it's always been, a cost benefit of enacting those remedies or not, right? Particularly in a broader main fund. There's always, well, not always, typically there's a larger relationship. Sometimes there's cash flow issues, things like that. So what I've typically done with my clients is actually put in some flexibility in terms of excuse provisions, things like that, because it is a fire sale at the time when you're gonna institute some of those default remedies. But I remember going back into 2000, 2001, and looking at all the larger institutions that we had as a client at that point, looking at all their documents, they all had similar default remedies. So for purposes of when I'm on the LP side, which I'm very rarely, I typically don't push back on that because they are market. And for the first question that you had over there, I do a ton of SPVs, and I have some family offices that also invest in the real estate. What I've seen is a movement towards a GP-LP structure, where the sponsor is the family office who provides a lot of the capital is either on the GP side or the LP side, depending on what the commercial relationship is. So to your point, there has been, at least in my practice, a limiting of the number of LPs, probably because of what you were talking about, right? But they know who's in the deal. They can either the sponsor, which can be the family office that maybe doesn't have the expertise, but they are on the GP side for economic benefits, et cetera, can choose who's in the deal with them. And if somebody has to step up, the family office, who is the GP, can step up and take over the deal.
One very last question, as long as the answer is yay or nay.
Yes.
GPM, the very number of funds, we took 300 million from Harvard and other local places to return multiple billions. And so my quick thoughts are, it's take it or leave it. All remedies, unless you're Harvard and you're lead and a professor. But two, on SPVs, I see it as a sign of weakness. If the sponsor is not performing, then they'll start doing SPV side vehicles to raise money around their best investment. And so I'm wary as a family office in SPVs of sponsors. Third thought, everybody can diligent sponsor, right? So the radio LP visits you in person every year, as an annual meeting, they come and they run through what they're doing and admit what they've done wrong, right? Because we all make mistakes.
But don't be too wary of SPVs because that is the structure for co-investment opportunities. Co-investment opportunities just simply means that there's an overflow opportunity and it's going to be put in an SPV. It's not, it doesn't mean there's anything.
I humbly dissent. I think that SPV means I can't raise enough money in my fund to fund it out of my fund, and I need help.
There is that concept of rescue funds. You're right.
Yeah, I think that's gonna demand more discussion.
You do it,
That's gonna demand more discussion. And again, we're gonna have a meeting in mid-October, a breakfast, where we hope you can come back and talk about fleshing out some of these things. So
Yeah, of course.
thanks so much. It's really great.
Thank you very much.